Global stocks are rising, while gold and oil prices fell overnight on easing tensions in the Middle East. Chinese authorities try to boost Hong Kong's stock market, and the copper price is on a tear. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Group Chief Economist Richard Yetsenga takes a closer look at Australia's worsening housing affordability challenges and why boosting housing supply may not be enough on its own.
The first thing is to start with the right mindset. If we acknowledge that this is a crisis and we start to use that word more often, what happens in a crisis is everything is on the table. Rather than things being ruled out, we rule everything in and just work out what we might be able to move and what might work.
But first in 5 and 5 with ANZ. Key global stock markets rose overnight, while gold and oil prices fell, signalling renewed investor appetite for riskier investments because tensions in the Middle East are easing. The S&P 500 was up 1.2% at 4 a.m. Sydney-Melbourne time. The UK's FTSE 100 closed up 1.6% at a new record high on a weaker pound and increased confidence about rate cuts from the Bank of England. US Treasury yields and the US dollar index were largely flat, the Aussie dollar trading up 0.5% at 64.49 US cents, while the Kiwi was up 0.46% at 59.17. In another sign of risk off, the gold price was down 3%, while oil was down 0.5%. ANZ senior commodity strategist Daniel Hines says concerns have eased around Middle East tensions disrupting global oil supplies.
The rhetoric from both sides suggested that both want to contain the impact of these skirmishes, and so oil markets pulled back a lot of those gains that we saw. The geopolitical backdrop is still very fraught with so many risks at the moment. So clearly we're going to see a lot of volatility until there's a lot more clarity around it.
Number 2, the Hang Seng closed up 1.8% overnight after Chinese securities regulators announced 5 measures to boost the Hong Kong stock market, including encouraging the largest Chinese mainland companies to list there. Here's ANZ's Chief Economist for Greater China, Raymond Yung.
This is the most important measures of the 5 because in the last few years, what happened was a slowdown of the Chinese economy at the same time with the lack of good company listed in Hong Kong. So this seems to be a response to the financial market weakness in the past few years. And the mainland or the central government seems to notice now is the time for them to do something so that the Hong Kong status as an international financial center can be maintained with the support of the onshore authorities, at the same time making use of Hong Kong as the international financial center to support the onshore fundraising. And that seems to be a win-win for both sides.
Number 3, but will these changes make it easier for Chinese investors to shift their money into Hong Kong dollar-denominated stocks? Here's Raymond.
No, I believe the regulators will push this idea very cautiously, even with more connects currently existing to facilitate the fund flows, especially the southbound flow, that we know that the onshore authorities remain very cautious about managing the capital outflow condition because the exchange rate has been under strong depreciation pressure recently.
Number 4, copper prices have been in the headlines recently, with prices sitting up 16% so far in 2024. Daniel says while the year's rally was initially driven by supply disruption, increased demand is now supporting prices as well.
Now it's more developed into, I think, a broader sign around the macroeconomic backdrop. And we've seen more positive data come out of China. The prospect of rate cuts in the US, even though they are being pushed out, does also present a bit of a tailwind for that market. So after being so unloved over the past year or so, we are seeing a lot of macro investors in particular really push into that metal as it tightens up.
Number 5, Singapore releases March CPI data today. ANZ Head of Asia Research, Koon Goh, expects the headline rate to fall from 3.4% in February to 2.8% in March. However, that's mainly due to a one-off price decline in Singapore's famous car certificates. Koon says the main focus is core inflation.
While core inflation is expected to tick down slightly to 3.4%, that's still very elevated and well above the long-term average. In fact, I don't expect the core inflation numbers to fall below 3% until Q4. So with elevated core inflation for some time, that's going to keep the MAS vigilant towards inflation risk, and the key reason why I don't expect the MAS to ease policy at all this year.
Couldn't go there. Now, in part one of our bonus deep dive interview, ANZ Group Chief Economist Richard Yetsenga takes a closer look at how to respond to Australia's worsening housing affordability and whether just increasing supply is enough.
The market-based response is to work hard on planning restrictions and to work hard to construct as many new dwellings as possible within, the existing settings of the system, like tax and other things, and go hard on both of those things with the expectation that will make a meaningful difference. And I'm quite sceptical that even if we do those things reasonably well, that we will be able to make a meaningful difference to the housing affordability measures that really matter. We might get more homes built and we might get higher density cities, both of which have some benefits. But will people who currently are struggling to buy homes be able to afford homes in that world? And I think the answer is no.
So there's a lot of, hope and confidence about upzoning. There's been lots of action in New South Wales in particular. But why are you saying that there won't be enough supply from increasing density and upzoning?
Well, look, first of all, I love parts of Paris, Madrid, Amsterdam. They're great to visit, and I think they're probably kind of great places to live in because of the walkability and the sense of community. And the experts tell me cities with more foot traffic are safer on the streets at night, and all these ancillary benefits. And of course, less pollution, making less room for cars and more room for people. But those cities built themselves over hundreds of years. I don't know that first home buyers are all that keen to wait that long. So certainly pursuing those objectives, I think, has a lot to go for them, but not as an affordability strategy, certainly in the near term. The other issue is housing is not a manufactured widget. When you try and increase the number of widgets dramatically, typically what will happen is the price per widget will fall because you get economies of scale. In the world in which we're in, where there's such demand on, let's call it heavy manufacturing, infrastructure, healthcare facilities, governments are ramping up defence, everybody's doing the climate transition. In fact, everybody's doing all of those other things as well. And then you want to build more houses. I don't see how you'll build houses at a lower cost per unit. It seems inevitable to me the cost of each additional house is going to go up. So even if you can get more houses, and the evidence is pretty sketchy that we're managing to deliver into our targets, even if you can get more houses, I don't think they'll do much to help housing affordability, if in fact anything.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, April the 23rd. Catch you tomorrow with part 2 of that deep dive interview with Richard, in which he talks about some of those pragmatic suggestions. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.